In my view, the most important investment principle is to buy low and sell high. This means that no matter what you're investing in, you should always ask yourself whether you're getting a good deal or not. If the price is low, there is a good chance you will make a profit. If the price is too high, you are likely to lose. The reason for this is that financial markets tend to move in waves. They fluctuate between undervalued and overvalued conditions. If the trend is on your side, you can have tremendous gains. But if it's moving against you, you could lose your shirt. This makes perfect sense. But how can we tell if an asset is cheap or not? This is the question we will try to answer today. In my previous videos, I've argued that due to central bank policy, almost every asset class you can think of is nowadays overvalued. Stocks, bonds, real estate, and even cryptocurrencies are all artificially inflated. The only assets which in my opinion are cheap are commodities, and especially the precious metals, gold and silver. In this video, I will demonstrate some of the valuation metrics which led me to this conclusion. I urge you to watch it till the end, because I have some charts to show that will blow your mind. The first indicator is called the cyclically adjusted price-to-earnings ratio. It is also known as the Shiller PE ratio after its inventor, Professor Robert Shiller from Yale University. A simple price-to-earnings ratio examines how many years a company needs to maintain its current earnings in order to justify its price. The Shiller PE ratio takes this idea a step further and compares the market cap of the company to the average inflation-adjusted earnings from 10 years prior. This tends to smooth out any outlier years, in which the earnings were unusually high or low. When we apply this to the entire S&P 500 index, we get a very interesting result. Over the past 150 years, this indicator stayed mainly between the values of 10 and 20. It has exceeded 30 only on a few rare occasions. The first one was just before the stock market crash of 1929, which signaled the beginning of the Great Depression. The second one was around the year 2000, at the height of the dot-com bubble. The third and last occasion is taking place right now. As you can see, a Shiller PE of 30 or more is associated with speculative bubbles and with historic crashes. This does not mean that a collapse is imminent. Obviously, the stock market can remain overvalued for several years, but it does suggest that the S&P 500 index is either headed lower or about to move sideways for several years. The handsome returns it has offered investors in the past decade are probably a thing of the past. Another important indicator regarding the health of the stock market is called the Buffett indicator, after the famous investor Warren Buffett, who first described it in a 2001 essay in Fortune magazine. This indicator divides the total market cap of US stocks by the US GDP. Historically, this ratio has rarely gone over 100%. During the dot-com bubble, it reached as high as 146%. And during the 2008 housing bubble, it reached 111%. Since 2013, it has been over 100% continuously. And in 2021, it reached an all-time high of 208%. Currently, it is at 160%. Just like the Shiller PE, the Buffett indicator shows that the stock market is highly overvalued. However, it has been this way for over 10 years, and there is no guarantee that it can't stay this way for years to come. But if we take into account the fact that inflation has finally erupted, and that for the first time in 40 years interest rates across the world are rising, I believe that this overvaluation is unsustainable. If we want to get an idea of what stock market valuations look like in an environment of high inflation and rising interest rates, we can have a look at the 1970s, when the Buffett indicator averaged about 40%. In order to get there, the stock market would either need to fall by 75% or the GDP would need to quadruple, without the stock market rallying at all, or some combination of the two. As you already understand, this is not a very pleasant scenario for stock market investors. Now let's have a look at the commodity sector. Unlike companies which have earnings, commodities are simply raw materials, and they don't generate a revenue stream. Therefore, we can't measure their value the same way as we do with stocks. The most basic way to value a commodity is by adjusting its price for inflation and comparing it to its past performance. In this presentation, we will adjust the prices according to present-day dollars. This means that the further we go back in time, the more the real price deviates from the nominal price. The most important commodity to consider is crude oil, which fuels our economy and is also used to produce plastics. The price of oil affects many other prices because every product needs to be transported from the producer to the consumer, and many products contain some kind of plastic. It is interesting to note that adjusted for inflation, the price of oil is relatively stable. Over the past 50 years, it has fluctuated mainly between $40 and $140 a barrel. In spite of the inflation we've experienced in the past 3 years, it is still in the lower half of this range, and therefore has the potential to double in price, without even setting a new all-time high. This kind of move in the price of oil will rattle the financial markets, and perhaps even lead to a recession. Although it is perfectly plausible, very few people are taking that into account. Another vital commodity is wheat. This staple food provides 20% of calories worldwide, and in some regions as much as 50%. The undervaluation here is much more extreme. Adjusted for inflation, the price of wheat is at an all-time low. One may argue that the reason for that is that human beings have learned how to produce wheat more efficiently. But the true story is more complicated than that. Most wheat is grown nowadays in highly mechanized monoculture farms, which consume large amounts of fuel, water, fertilizer, and pesticides. The price of the final product is highly dependent on the availability of these raw materials. In case of a shortage of fossil fuels, wheat production is expected to decline. On top of that, the low price of agricultural commodities in the past decades has disincentivized investment, and very few young people are willing to enter this field. As a result, the average age of farmers in the US is now over 57 years old. When it comes time for them to retire, there will be no one there to replace them. This indicates to me that in the coming years, the price of wheat is destined to rise. How high can it go? Well, in order to reach its 1974 high, the price needs to rise by a whopping 688%. It is perfectly possible because adjusted for inflation, the price has already been this high. Unfortunately, this kind of move will have dire consequences on the food security of millions of people across the world. Wouldn't it be wonderful if we could purchase in advance all the commodities we're going to use throughout our lives? This way we wouldn't need to worry about inflation. Unfortunately, this is impossible. Food products such as wheat and rice have a limited shelf life and can only be stored for several years. Other commodities such as crude oil or natural gas are hazardous and cannot be stored at home in large quantities. Furthermore, in order to do so, we would need a large storage area, which most people simply don't have. Instead of storing the physical commodities, we could purchase futures contracts which allow us to lock in the current price and protect ourselves from any future price increase. However, there are costs associated with holding those contracts, and most people are not sophisticated enough to do that. There is only one kind of commodity which is practical to store at home. It's compact enough to fit into a small safe and has an unlimited shelf life. I'm referring, of course, to the precious metals, gold and silver. This is the only way for the average person to get a direct exposure to the commodity sector without the need of an intermediary such as a broker-dealer. This is why they tend to outperform during times of high inflation. I argue that they are just as undervalued as crude oil or wheat, and therefore have the potential to protect us from the price increase of the commodities which we consume on a regular basis. Adjusted for inflation, the price of gold right now is lower than it was in any of its 3 previous peaks. In today's dollars, the price of gold during the summer of 2020 was $2,462 per ounce. During the 2011 peak, it was $2,610 per ounce, and during the 1980 peak, it was no less than $3,453 per ounce. As we've explained earlier, the price of gold can easily retrace any of these highs, because in real terms it has already been there before. The undervaluation of silver is even more extreme. In today's dollars, its 2020 high equals $35.4 an ounce. Its 2011 high equals $68.3 an ounce. And its 1980 high is comparable to no less than $189.3 an ounce. This means that silver represents nowadays a tremendous value and has the potential to appreciate even more than gold. But gold and silver are not regular commodities which are merely consumed in industry. Although we no longer use them as money, people still remember their monetary role and treat them as investments. Therefore, in order to assess their current value, we can compare them to other asset classes, such as the S&P 500 index. The rationale behind this comparison is that the prices of these two assets must maintain a certain proportion between them. Otherwise, we would get absurd situations, in which, for instance, a single tech company has enough free cash to purchase the entire available stock of gold or silver. Since these metals are essential for the production of electronic circuits, it would be very tempting for it to do that, and this way prevent its competitors from manufacturing their products. This is why I argue that there is a limit on how much these asset classes can deviate from each other, and if the discrepancy becomes too great, we should expect a reversion to the mean. If we compare the price of gold to the S&P 500 index, we will be amazed to discover that it is almost at its all-time low. Even though nominally it is higher than it was during its 2011 peak, and far higher than it was during its 1980 peak, compared to the stock market, it is dirt cheap. In order to reach the same ratio with the S&P 500 index that it had in 1980, gold would need to rally no less than 754%. Again, it is perfectly possible, because it already happened in the past. Furthermore, there is nothing preventing this ratio from rising even further than that. Keep in mind that when a ratio reverts to the mean, it often overshoots. But if you want to see a chart that will really blow your mind, take a look at this one. This is the ratio between the price of silver and the S&P 500 index. Compared to the stock market, the rally we have seen in silver in 2020 is literally invisible. And the huge rally we've had between 2000 and 2011 is nothing but a tiny blip. According to this measure, silver is so undervalued that it's practically free. In order for it to retrace its 1980 ratio with the S&P 500 index, it would need to rally no less than 8,580%. That's right, 8,580%. I know it sounds absurd, but since silver has already been there, there is nothing preventing it from happening. It would simply be doing what it has already done in 1980. For the sake of clarity, I'm not saying that gold and silver will indeed rally by that amount. I don't have a crystal ball, and I can't predict the future. I'm only presenting this data as an indication of how undervalued the precious metals currently are compared to their past performance. Will they reproduce these results in an environment of low growth and high inflation? That is for you to decide. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.